Question 1. Which of the following is not required for an insurable interest to exist in a life insurance policy? A. The policy owner must expect to suffer a financial loss if the insured dies. B. The insurable interest must exist at the time of policy application. C. The policy owner must be related to the insured by blood or marriage. D. The policy owner must have a reasonable expectation of benefit from the continued life of the insured. Answer: C. The policy owner must be related to the insured by blood or marriage. While a blood or marriage relationship often establishes an insurable interest, it is not a strict requirement for life insurance. The crucial element is a reasonable expectation of financial loss or benefit from the continued life of the insured, which must exist at the time of application. This ensures that the policy isn't used for wagering purposes, as insurable interest prevents policies from being taken out by individuals who stand to gain from another's death without a legitimate connection. Remember that financial dependency or a business relationship can also create a valid insurable interest. Question 2. If a life insurance policy lapses due to non-payment of premium, within what timeframe can it typically be reinstated in Georgia? A. 1 year from the date of lapse. B. 3 years from the date of lapse. C. 5 years from the date of lapse. D. There is no limit on reinstatement, provided all back premiums are paid. Answer: C. 5 years from the date of lapse. In Georgia, a life insurance policy that has lapsed due to non-payment of premiums can generally be reinstated within 5 years from the date of lapse. To reinstate, the policy owner typically needs to pay all back premiums with interest, provide proof of insurability, and repay any outstanding policy loans with interest. This reinstatement provision offers a valuable safety net, allowing policyholders to restore their coverage without needing to apply for a brand new policy at a potentially higher premium rate. Always remember that timely premium payments are key to maintaining active coverage. Question 3. All of the following are characteristics of a whole life insurance policy, except A. Fixed premium. B. Guaranteed cash value. C. Level death benefit. D. Flexible premium payments. Answer: D. Flexible premium payments. Whole life insurance is characterized by a fixed, level premium that is paid for the entire life of the insured, up to age 100 or beyond. It also features a guaranteed cash value that grows over time and a level death benefit. The option for flexible premium payments is typically a characteristic of universal life insurance, not traditional whole life policies. Think of whole life as set it and forget it regarding premiums, offering stability and predictability. Question 4. An annuity period is best described as the time during which A. Premiums are being paid into the annuity. B. The accumulated funds are converted into a stream of income payments. C. The annuitant can surrender the contract without penalty. D. The insurer assesses the annuitant's life expectancy. Answer: B. The accumulated funds are converted into a stream of income payments. The annuity period, also known as the annuitization period or payout period, is the phase when the accumulated funds in an annuity contract are systematically paid out to the annuitant. This follows the accumulation period, during which premiums are paid in and the funds grow. Once the annuity period begins, the annuitant starts receiving regular income payments, which can be for a specified period or for the rest of their life. Consider it the retirement income phase of the annuity. Question 5. A waiver of premium rider typically waives the premium if the insured becomes A. Unemployed. B. Disabled. C. Divorced. D. Financially distressed. Answer: B. Disabled. A waiver of premium rider is a common addition to life insurance policies designed to protect the policy if the insured becomes totally and permanently disabled. If the insured meets the definition of disability as outlined in the rider, the insurance company will waive future premium payments while the disability persists. This ensures the policy remains in force and the death benefit is preserved, preventing a lapse due to the insured's inability to work and pay premiums. It's a valuable safeguard for income protection. Question 6. An insurance producer who mixes premiums collected from clients with their own personal funds is guilty of A. Twisting, B. Rebating, C. Commingling, D. Defamation. Answer: C. Commingling. Commingling refers to the illegal practice of an agent or broker mixing their personal funds with the funds of clients or the insurer. This is a serious violation of fiduciary duty, as insurance premiums belong to the insurer and must be kept separate in a trust account. Maintaining separate accounts prevents misuse of client funds and ensures financial accountability. Always keep client money distinct from your own to avoid this serious ethical and legal breach. Question 7. The free look period in a life insurance policy issued in Georgia allows the policy owner to return the policy for a full refund within how many days of delivery? A. 5 days. B. 10 days. C. 20 days. D. 30 days. Answer: B. 10 days. In Georgia, a life insurance policy typically includes a 10-day free look period, also known as a right to examine period. This provision allows the policy owner to review the policy after delivery and, if unsatisfied for any reason, return it to the insurer for a full refund of all premiums paid. This consumer protection ensures buyers have time to thoroughly understand their contract without commitment. Remember, the clock starts ticking from the date the policy is delivered to the owner. Question 8. In most cases, the death benefit proceeds from a life insurance policy paid to a named beneficiary are A. Subject to income tax, B. Subject to capital gains tax, C. Income tax-free, D. Subject to estate tax only if the estate is small. Answer: C. Income tax-free. Generally, the death benefit proceeds paid to a named beneficiary upon the death of the insured are received income tax-free. This is a significant tax advantage of life insurance, as the full face amount of the policy is available to the beneficiaries without being reduced by income taxes. While there can be estate tax implications for very large estates, the payout itself is not considered taxable income for the beneficiary. This makes life insurance a powerful tool for family financial protection. Question 9. An insurance producer who makes false or malicious statements about another insurer's financial condition commits the unfair trade practice of A. Boycott, B. Coercion, C. Defamation, D. Misrepresentation. Answer: C. Defamation. Defamation is an unfair trade practice involving making false or malicious statements about the financial condition of another insurer or agent, or about the character of an insurer's employees or policies. This is illegal because it aims to harm the reputation and business of competitors through untrue statements. Producers must always compete fairly and honestly, focusing on the merits of their own products rather than disparaging others. Remember, integrity is paramount in the insurance industry. Question 10. A life insurance policy's suicide clause typically states that if the insured commits suicide within a specific period after the policy's issue date, the insurer will A. Pay the full death benefit, B. Refund the premiums paid, C. Pay nothing to the beneficiary, D. Pay a reduced death benefit. Answer: B. Refund the premiums paid. Most life insurance policies include a suicide clause, which specifies that if the insured commits suicide within a certain period, typically 2 years from the policy's issue date, the insurer's liability is limited to a refund of the premiums paid. If suicide occurs after this 2-year period, the full death benefit will usually be paid. This clause is designed to prevent individuals from purchasing life insurance with the intent of committing suicide shortly thereafter to defraud the insurer. Question 11. Which type of life insurance policy is designed to provide coverage for a specific period and typically does not build cash value? A. Whole life. B. Universal life. C. Variable life. D. Term life. Answer: D. Term life. Term life insurance provides coverage for a specified period, or term, such as 10, 20, or 30 years. Unlike permanent life insurance policies, term life does not accumulate cash value and is generally the most affordable type of life insurance for a given death benefit amount. It's often chosen to cover specific temporary needs, like the years a mortgage is outstanding or until children are grown. Think of it as temporary protection, similar to renting insurance coverage. Question 12. In Georgia, when a life insurance policy is being replaced, the replacing insurer must: A. Advise the applicant to consult their existing insurer. B. Provide the applicant with a notice regarding replacement. C. Obtain a list of all existing life insurance policies from the applicant. D. All of the above. Answer: D. All of the above. When replacing a life insurance policy in Georgia, the replacing insurer has several responsibilities to protect the consumer. These include advising the applicant to consult with their existing insurer, providing the applicant with a notice regarding replacement form, and obtaining a comprehensive list of all existing life insurance policies from the applicant. These steps ensure the applicant is fully informed about the potential disadvantages of replacement, such as new contestability periods or surrender charges, before making a decision. Transparency is key in replacement situations. Question 13. During the accumulation period of a deferred annuity, the annuitant can typically do all of the following except: A. Make additional premium payments. B. Surrender the contract for its accumulated value. C. Begin receiving income payments. D. Transfer funds between investment options in a variable annuity. Answer: C. Begin receiving income payments. The accumulation period of a deferred annuity is the phase during which the annuity owner pays premiums into the contract, and the funds grow on a tax-deferred basis. During this time, they can make additional contributions, surrender the contract, though often subject to surrender charges, and in a variable annuity, reallocate funds. However, income payments only begin once the contract moves into the annuitization or payout period. The accumulation period is about building up the fund, not drawing it down. Question 14. Which of the following statements about policy loans on a whole life insurance policy is true? A. Policy loans must be repaid within a specific time frame, typically 10 years. B. Interest is charged on policy loans. C. Policy loans are subject to income tax. D. If a policy loan is outstanding at death, the insurer will not pay the death benefit. Answer: B. Interest is charged on policy loans. Policy loans from a whole life insurance policy's cash value are essentially loans against the policy itself, and interest is always charged on the outstanding loan balance. While policy loans do not have to be repaid, any outstanding loan plus interest will be deducted from the death benefit if the insured dies before repayment. They are generally not taxable, but they do reduce the net death benefit payable to beneficiaries. Think of it as borrowing from your own savings account, with interest. Question 15. If a life insurance policy designates beneficiaries as per stirpes, and one primary beneficiary dies before the insured, who receives that deceased beneficiary's share? A. The insured's estate. B. The remaining primary beneficiaries equally. C. The deceased primary beneficiary's heirs. D. A contingent beneficiary, if named. Answer: C. The deceased primary beneficiary's heirs. The term per stirpes, meaning by the roots or by branches, specifies that if a named beneficiary dies before the insured, that beneficiary's share of the proceeds will pass to their direct descendants, their children, if any. This differs from per capita, where the proceeds are divided equally among the surviving named beneficiaries. Per stirpes ensures that the bloodline of the deceased beneficiary is maintained in the distribution. It's a key detail in beneficiary designations to ensure the policy's proceeds go exactly where the policy owner intended. Question 16. A life insurance policy illustration must include A. Guaranteed and non-guaranteed elements. B. Historical policy performance over the last 20 years. C. A guarantee of future dividends. D. A projection of the insured's health status. Answer: A. Guaranteed and non-guaranteed elements. A life insurance policy illustration is a crucial tool designed to show how a policy might perform over time. It must clearly distinguish between guaranteed elements, such as guaranteed interest rates or cash values, and non-guaranteed elements, like projected dividends or interest earnings, which are based on current assumptions and can change. This transparency helps potential policyholders understand both the certainties and the potential fluctuations of their policy. Remember, non-guaranteed elements are projections, not promises. Question 17. Which of the following is a common characteristic of group life insurance? A. Each individual member receives their own policy. B. Individual members typically undergo medical underwriting. C. The employer is usually the policy owner. D. Premiums are based on the individual age and health of each member. Answer: C. The employer is usually the policy owner. In group life insurance, the employer or association is typically the policy owner, holding a master contract that covers all eligible members. Individual members receive certificates of insurance, not separate policies. Coverage is usually provided without individual medical underwriting, and premiums are based on the risk characteristics of the entire group. This makes group life insurance an affordable and convenient benefit for many employees. Question 18. The incontestability clause in a life insurance policy generally prevents the insurer from denying a claim based on misstatements in the application after the policy has been in force for how long? A. 6 months. B. 1 year. C. 2 years. D. 5 years. Answer: C. 2 years. The incontestability clause is a standard provision in life insurance policies that typically states that after the policy has been in force for 2 years, the insurer cannot deny a claim due to material misstatements made in the original application, except for fraud. This clause provides security to the policyholder, knowing that after the specified period, the insurer cannot challenge the validity of the contract. It protects beneficiaries from unexpected claim denials long after the policy was issued. Question 19. Which life insurance policy offers flexible premiums and a death benefit that can be adjusted, along with a cash value account that grows based on current interest rates? A. Whole life. B. Term life. C. Universal life. D. Variable life. Answer: C. Universal life. Universal life insurance is a type of flexible premium adjustable life insurance that allows policyholders to change the amount of premium paid and the death benefit. Its cash value grows based on current interest rates, and it offers transparency, separating the cost of insurance from the cash value accumulation. This flexibility makes it attractive for those whose financial needs may change over time. It provides adaptability that traditional whole life policies lack. Question 20. In Georgia, how often are licensed insurance producers generally required to complete continuing education (CE) requirements? A. Annually. B. Biennially, every 2 years. C. Every 3 years. D. Only once after initial licensing. Answer: B. Biennially, every 2 years. In Georgia, licensed insurance producers are generally required to complete continuing education (CE) credits biennially, meaning every 2 years, to maintain their license. This ensures that agents stay current with industry changes, regulations, and best practices. Staying informed is crucial for providing competent advice and service to clients. Always check the Georgia Department of Insurance website for the most up-to-date CE requirements for your specific license type. Question 21. When advertising life insurance in Georgia, which of the following is generally prohibited? A. Using the words investment or investment plan in relation to life insurance. B. Stating the guaranteed interest rate on a policy. C. Providing a policy illustration with guaranteed and non-guaranteed elements. D. Advertising a life insurance policy's tax advantages. Answer: A. Using the words investment or investment plan in relation to life insurance. Georgia insurance regulations, like those in many other states, generally prohibit the use of terms like investment, investment plan, or profit in relation to life insurance policies when advertising. This is to prevent consumers from misunderstanding that life insurance, while it may have a cash value component, is primarily an insurance product, not a security or a typical investment vehicle. It's about ensuring clear and accurate representation to the public. Question 22. Which non-forfeiture option allows a policy owner to use the cash value to purchase a new policy with a lower face amount, but for the same duration as the original policy? A. Cash surrender value. B. Extended term option. C. Reduced paid-up insurance option. D. Automatic premium loan. Answer: C. Reduced paid-up insurance option. The reduced paid-up insurance non-forfeiture option allows the policy owner to use the existing cash value as a single premium to purchase a new, fully paid-up permanent life insurance policy with a reduced face amount. The new policy's coverage continues for the same duration as the original policy, usually up to age 100. This is a good option if you want to stop paying premiums but retain some level of permanent coverage. Question 23. A characteristic of a variable annuity is that A. Its cash value grows at a fixed, guaranteed interest rate. B. It offers a guaranteed minimum death benefit. C. The annuitant bears the investment risk. D. It is regulated solely by state insurance departments. Answer: C. The annuitant bears the investment risk. A key characteristic of a variable annuity is that the annuitant bears the investment risk, as the cash value and death benefit fluctuate based on the performance of the underlying investment subaccounts. While some variable annuities may offer optional guaranteed minimum death benefits or living benefits riders for an additional cost, the primary investment risk lies with the contract owner. Because of this investment risk, variable annuities are regulated by both state insurance departments and the SEC/FINRA. Question 24. Upon the death of the insured, the beneficiary must provide the insurer with A. A copy of the insured's will. B. Proof of loss, typically a certified death certificate. C. A notarized statement from a family member. D. The original policy contract. Answer: B. Proof of loss, typically a certified death certificate. To initiate a life insurance claim, the beneficiary must provide the insurer with proof of loss, which is usually a certified copy of the insured's death certificate. This document officially confirms the death of the insured and allows the insurer to process the claim and pay the death benefit. While other documents might be requested in specific circumstances, the death certificate is the fundamental requirement. It's the critical piece of evidence needed to activate the policy's payout. Question 25. The Georgia Commissioner of Insurance has the authority to do all of the following except A. Issue, deny, or revoke insurance licenses. B. Conduct examinations of insurance companies. C. Set premium rates for all insurance products in the state. D. Enforce insurance laws and regulations. Answer: C. Set premium rates for all insurance products in the state. While the Georgia Commissioner of Insurance regulates the insurance industry, reviews rates, and approves forms, they do not directly set premium rates for all insurance products. Insurers typically propose rates, which the Commissioner's office then reviews to ensure they are not excessive, inadequate, or unfairly discriminatory. The Commissioner's primary role is regulatory oversight, including licensing, market conduct examinations, and enforcing compliance with state insurance laws.